Welcome to Talk Tickers, the show for the experienced investor, where we strip away the fluff and get straight to the alpha. Today is Wednesday, January 28th, 2026, and we are dissecting the Q4 2025 print from Northrop Grumman. That's ticker NOC. We have a lot of ground to cover, a record backlog, a huge shift in capital strategy, and maybe a trade setup hiding in plain sight.
It's good to be back. And frankly, if you were watching the tape yesterday, you saw masterclass in market psychology. It was messy, it was volatile, and it ended up telling a very, very specific story about where the defense sector is heading.
Let's start right there with the price action, because the chart yesterday looked like a heart attack on paper.
It really did.
The stock opens week down about 2%, and the pre-market traders are jittery, the algorithms are hitting the bid.
Yep.
And then right around the time the conference call gets into the Q&A, you see this massive intraday reversal. NOC closes up 2.69% at $678.74.
That is a nearly 5% swing from the low to the high. For a low beta defense prime, that just doesn't happen by accident.
No, it doesn't.
That V-shaped recovery is the market digesting two very different narratives. The pre-market drop was a reaction to the headline guidance, which we'll get to. It looked soft.
Right.
The intraday rally was the smart money realizing that the guidance was a floor, not a ceiling, and buying into the long-term thesis.
So what's the thesis then?
If I had to summarize this entire deep dive into a single phrase, it's this: capacity over buybacks.
Capacity over buybacks. That is a dangerous game to play with Wall Street. Usually funds want their return on capital immediately.
Accrued purchases, exactly.
And you're suggesting the market actually rewarded Northrop for telling them, no, we're keeping the cash to build factories.
That's exactly what happened. In 2026, he with the most manufacturing capacity wins. But before we unpack the strategy, we need to establish the baseline. The numbers were good, but were they good enough?
Yeah, let's run the tape. Revenue came in at $11.71 billion, up 10% year over year. Consensus was sitting at $11.6 billion, so a clean top-line beat. On the bottom line, adjusted ETS hit $7.23 against the street expectation of roughly $6.98.
So operationally, they're executing, no question. But revenue and EPS are lagging indicators. They tell you what happened 3 months ago. The metric that really matters for the forward-looking investor here is the backlog.
The coiled spring.
Exactly. Northrop posted a new company record backlog of $95.68 billion.
Wow.
That is nearly $96 billion of secured funded work. To put that in perspective, that's up almost 5% year over year. That provides incredible visibility.
Speaking of visibility, the cash flow number really jumped out at me.
Right.
FY 2025 free cash flow hit $3.3 billion. That's up 26% year over year.
That 26% jump is the most important number in the print.
Why that one specifically?
It signals that the supply chain hell is over. They are getting the microelectronics, they're getting the titanium forgings, and they are converting that massive backlog into actual cash.
So this execution is validated.
When you see free cash flow ramping that hard, absolutely.
Okay, so we have a top line beat, a bottom line beat, record backlog, and cash flowing like water. Let's play devil's advocate. Why did the stock gap down 2% in the pre-market?
It was the 2026 guidance, specifically the sales guide. The street had a certain growth trajectory penciled in. Analysts are feeling bullish. Then Northrop came out with a 2026 revenue range of $43.5 billion to $44.0 billion.
Which was light relative to consensus.
It was below the whisper number. And in this market, if you guide light even by a little, the algos sell first and ask questions later. It looked like a growth deceleration.
But this is where the nuance of the conference call comes in. The CEO, Kathy Warden, was pressed hard on this.
Analysts asked if she was sandbagging, if she was being conservative.
And she refused to use that word. She called the guidance balanced.
Balanced. That is careful CEO speak for, I am not promising revenue for contracts that aren't legally signed yet.
So this is the critical friction point.
It is. If you're holding NOC or thinking about entering, you have to understand what is missing from that guidance.
You're referring to the B21 Raider acceleration.
The B21 Raider and the FAXX program, also known as APEX, these are two massive potential revenue streams. We know the Air Force wants more B21s, and they want them faster.
But because the final contract mod for that accelerated production rate hasn't been inked,
management physically cannot include those numbers in the formal guidance.
So the pre-market drop, was the market reading the headline, which assumes the status quo.
And the intraday rally was the realization that the guidance is a minimum viable product. It's the worst case scenario where they don't sign the deal.
Which seems unlikely.
Precisely. The smart money realized that $43.5 billion is the floor. If or when they sign the B21 acceleration, the model breaks to the upside immediately.
That explains the price action. Now, I want to pivot to the hardware itself, because usually when we talk about prime contractors, we think steady, reliable, but slow.
Decades to develop a platform.
Yeah. But there was a segment in this earnings call about Project Talon that sounded, I don't know, uncharacteristically agile.
This was the most fascinating technical reveal of the quarter. Northrop is clearly tired of the narrative that Silicon Valley startups are the only ones who can move fast.
So what did they do?
So they dropped the curtain on the YFQ-48A.
The YFQ-48A. And just to define terms, this is a CCA, a collaborative combat aircraft.
Correct. It's the industry term for a loyal wingman, an unmanned drone designed to fly alongside a manned fighter like the F-35 or the B-21.
So it's a sensor, a weapons truck, a decoy, that sort of thing.
All of the above. But the headline here isn't what the drone does, it's how fast they built it.
They claimed under 24 months from concept to hardware.
Under 24 months. They use their Talon IQ ecosystem, which is their proprietary digital twin and agile manufacturing suite. They went from a digital file to a physical bird on the ramp in 2 years.
And it has a Y designator. That's not just a marketing name.
No, a Y designator comes from the Air Force. It means the USAF is treating it as a legitimate prototype aircraft, not just a vendor demo or a PowerPoint deck.
That's a huge validation. It proves Northrop can compete on speed.
They aren't just the bomber guys who take 15 years to develop a platform. They're showing they can move at the speed of an Anduril or a Shield AI, but with the manufacturing scale of a prime.
It feels like a direct shot across the bow of the venture-backed defense tech sector. Yeah. They're saying, we can do agile too, but we actually have the factories.
And they're doing it profitably. Look at the space segment. Operating income was up 17% in Q4. Space is usually a capital sinkhole, but they're expanding margins.
How are they driving that? Is it all classified work?
It's a mix. The classified portfolio, which we can't see but assume is high margin, is definitely part of it. But they also highlighted a commercial win, Amazon's Project Elio.
It's the Kuiper constellation.
Yes. Northrop is building the GM-63 solid rocket motors for the launch vehicles that will put Amazon satellites up.
That is an interesting signal. I mean, Amazon is arguably the most cost-conscious buyer on the planet.
It is. If they're buying from Northrop, it implies the new space startups couldn't deliver the reliability or the volume Amazon needs.
Right. You can disrupt software, but you can't disrupt physics.
Exactly. Which brings us squarely to the central theme of this episode, the industrial base play.
Capacity over buybacks.
Yep. Let's unpack the buyback side of that first. Management explicitly stated they are not authorizing new share repurchases right now.
And typically that is a death knell for a mature stock. Investors want yield.
They want the share count reduced to artificially boost EPS.
Right. Where is my return of capital? But here, the stock went up. Why did the market give them a pass?
Because the market has finally accepted this supply chain constrained reality. We are in a world where every NATO country, plus partners in the Pacific, plus the U.S. services, are all screaming for munitions.
The bottleneck isn't the tech anymore. It's the industrial capacity.
It's the arsenal of democracy problem. We have the blueprints, but we don't have the assembly lines.
And Northrop is tackling this
with what they call the rocket motor moat. They have already doubled their tactical solid rocket motor capacity at the West Virginia facility since 2021.
Doubled in 4 years. That's significant.
It is, but they aren't stopping. The plan they outline is to increase that capacity by another 50% by early 2027.
So effectively tripling their output in a 6-year span.
Yes, and they are doing the same thing at the Elkton, Maryland site, tripling capacity by 2030.
But this brings us back to capital allocation. Building factories is expensive. It burns cash.
It does.
So why is this a better use of funds than buying back stock?
Because of the ROIC, the return on invested capital. If they buy back stock, they get a momentary bump in EPS. If they build a solid rocket motor factory right now, given the geopolitical demand, that factory is going to print money for the next 20 years.
So they are betting that the demand isn't a spike, but a secular shift.
Precisely. They are keeping the share count flat to pour cash into CapEx projected at $1.65 billion for 2026. They are choosing physical assets over financial engineering because they are betting on historic growth.
And Kathy Warden referenced that potential $1.5 trillion FY27 defense budget recommendation.
A staggering number. Even if it gets trimmed in the House or Senate, the direction of travel is undeniable.
So if that budget passes, or even lands at $1.2 or $1.3 trillion,
the companies that have the physical factories ready to go are the ones that win. You cannot download a rocket motor. You have to build it.
it's a land grab for industrial capacity. And it's not just the U.S., right?
No, that's the global demand signal. International sales grew 20% in 2025. And the book-to-bill internationally is expected to be well above 1.0.
And just to clarify for the listener, a book-to-bill above 1.0 means for every dollar of product they shipped, they booked orders for more than $1 coming in.
Correct. The backlog is growing faster than they can burn it down. They specifically mentioned the IBCS, the Integrated Battle Command System.
That's the brain of air defense, right?
Yeah.
Ties different radars and shooters together.
Yes. And look at the world map. With the conflicts in Eastern Europe and the Middle East, every nation wants Golden Dome-style missile defense. The macro backdrop is tragic, let's be clear, but from an investment standpoint, it's a massive tailwind.
One quick thing, the CFO transition. Ken Cruz is out, John Green is in. Any of your flags?
Zero. This was a very smooth, scripted handoff. John Green has been in the organization for a while. There were no nasty surprises, no restatements. In the defense sector, boring is what you want in the C-suite.
Right. Stability lets the CEO focus on the strategy.
Exactly.
So let's summarize the bull case here before we get to the trade idea. The flywheel is execution drives cash, cash drives capacity investment, and capacity captures the record backlog.
That's the formula. It's boring, industrial, capital intensive. It doesn't have software margins, but it has a massive competitive moat.
Okay, let's switch gears. This is the part of the show where we take off the analyst hat and put on the hedge fund hat.
So this is not financial advice segment.
Absolutely. Disclaimer, we are just two voices on a deep dive. Do your own diligence.
Don't blame us if you lose your shirt.
Seriously, check your own risk models. But if you were pitching a trade to an investment committee right now, what's the play?
I call this the Rocket Factory calendar spread.
Technical and catchy. Walk us through the thesis.
The thesis relies on that event-driven catalyst we talked about, the B21 acceleration negotiation. Kathy Warden explicitly said she is optimistic they will get an agreement with the Air Force this quarter.
This quarter, meaning inside Q1 2026.
Yes. And remember, the 2026 guidance is balanced. It does not include this deal. The moment that deal is inked, the revenue model breaks to the upside.
So the current stock price is pricing in the balanced guidance, but the contract award is pure upside.
Pure optionality. You are betting on the press release.
So what's the structure of the trade?
You look at a calendar call spread. You sell a near-term call, maybe 30 days out, to finance the purchase of a longer-dated call, say for late Q2. You want exposure to the pop that comes from the headline.
Why the calendar spread instead of just buying calls?
Because implied volatility usually drops right after earnings. You want to take advantage of that relatively cheaper premium on the long leg, but you sell the short leg to lower your cost basis just in case the negotiations drag.
And the downside? What if the Pentagon drags its feet?
That is the primary risk. But that's where the floor comes in. If the deal drags out, you have that solid $3.3 billion free cash flow supporting the stock price.
You saw that yesterday. Investors are willing to buy the dip.
Exactly. The downside seems capped by execution quality, while the upside is uncapped by the pending contract. It's an asymmetric bet. You're effectively front-running the paperwork.
That's where the alpha is.
It is. The market hates uncertainty, but in this case, the uncertainty is skewed to the upside.
I like it. It's aggressive, but it's grounded in the transcript.
It's the only way to play a balanced guide in a bull market.
So, bringing it all back home, Northrop Grumman delivered a clean beat, a record backlog, a massive cash ramp. But the real signal...
The thing I want the listener to walk away with is the refusal to buy back stock.
Yeah.
It's a signal of confidence. Think about it. If a company buys back stock, they're often saying, we don't have any better ideas for this money.
It's admitting they are a utility.
Right. Northrop is doing the opposite. They are saying, we have a great idea for this money. We're going to build massive factories to build massive missiles because the world is about to spend $1.5 trillion on defense.
That is a powerful final thought. The lack of buybacks isn't a weakness. It's a signal of massive internal demand for capital.
And in this geopolitical environment, capacity is the only thing that matters. If you can build it, they will buy it.
Well, there you have it. Capacity is king. Keep an eye on those B21 headlines in the coming weeks. That might be the catalyst to watch. This has been the Talk Tickers Deep Dive on Northrop Grumman. Thanks for listening.
We'll see you at the next bell.